California's housing narrative was built on permanence, permanent demand, permanent appreciation, permanent scarcity. For decades, the suburbs of the Golden State were marketed as the rational man's move, stable neighborhoods, rising equity, schools that justified the tax bill, and a commute that felt like the cost of ambition. That story is no longer holding. What we are witnessing is not chaos, it's exposure. Prices across many of California's most celebrated exurbs have fallen between 10 and 22% in a single year. That isn't a ripple, it's structural repricing. The forces behind it are not mysterious. Remote work severed the commute premium. Insurance costs exploded. Water restrictions tightened. Speculative construction overshot demand. And the middle class quietly recalculated its tolerance for debt. For the first time in 15 years, the leverage has shifted. And if you are disciplined, patient, and informed, that shift matters. This is not about panic. It's about positioning. Let's examine what is actually happening, city by city, market by market, without hype, without nostalgia, and without denial. Vallejo, the Bay Area's pressure, Valve reverses Vallejo, was once framed as the rational alternative to San Francisco pricing. Waterfront views, ferry access, relative affordability, a strategic foothold for professionals priced out of the urban core. Median prices have fallen roughly 12% to around $550,000. Why? The port of Vallejo and surrounding logistics sectors slowed. Pandemic-era buyers who stretched on adjustable rate loans are resurfacing in foreclosure data. More importantly, the commute premium evaporated. When remote work became normalized, the reason to live 30 miles from downtown San Francisco weakened overnight. Inventory expanded. Days on market lengthened. Bidding wars cooled into inspection contingencies. Yet here's what hasn't deteriorated. Housing stock quality has improved. Renovations completed during the boom remain. Infrastructure upgrades around Mare Island are intact. Schools have stabilized. This is not decay. It is repricing. Buyers are no longer competing emotionally. They are negotiating structurally, requesting roof certifications, updated electrical panels, foundation credits. Vallejo is no longer a speculative shortcut to the Bay Area dream. It is simply space near water at a number that must now justify itself. Antioch, oversupply meets reality. Antioch absorbed thousands of buyers fleeing Oakland and San Francisco during peak pricing years. Today, prices are down approximately 15% to near $520,000. Over 2,000 new units entered the market recently under the assumption that migration would remain constant. It did not. Remote work reduced geographic necessity. Interest rates constrained affordability. Demand paused while supply kept moving. The result? Listings lingering 60 to 90 days. Sellers offering closing credits. Concessions on appliances. Repair allowances. The Delta views are unchanged. School ratings remain respectable. Infrastructure is stable. But scarcity is gone. Scarcity is what fuels irrational bidding. Without it, valuation becomes analytical again. A disciplined buyer now reviews roof age, HVAC lifespan, mellow roofs, taxes, HOA reserves. Negotiation replaces urgency. That shift is not a crash. It is adulthood returning to the transaction. Stockton, from logistics hub to reset zone. Stockton has seen prices decline roughly 18% to near $420,000. Agricultural pressures, supply chain volatility, and logistics contractions weakened wage stability. During boom years, investors poured in, anticipating perpetual inland migration. When rates rose, Speculative demand receded, yet Stockton's fundamentals are more complex than headlines suggest. Downtown revitalization continues. The waterfront remains underutilized but structurally sound. University of the Pacific is expanding health and professional programs, anchoring long-term employment. Commute time to Sacramento remains under 45 minutes. Lot sizes are significantly larger than coastal equivalents. Entry pricing relative to square footage is among the most aggressive in Northern California. The correction is severe, but the floor is tangible. Stockton is no longer a momentum trade. It is a value proposition. Modesto agricultural recalibration. Modesto experienced a 14% price contraction to roughly $450,000. Water rights, tightening, and almond market volatility reshaped local agricultural economics. Consolidation reduced mid-tier farm ownership, compressing the income layer that typically supports suburban stability. Yet foreclosure rates remain comparatively low. Distress-driven markets collapse rapidly. Modesto is experiencing demand withdrawal, not financial implosion. Tree-lined streets remain maintained. School performance remains above state averages. Access to Yosemite positions. Modesto as both practical and recreationally strategic. Buyers are not fighting. They are selecting. In markets like this, patient capital wins. Fresno. The new baseline of affordability. Fresno has dropped approximately 16% to near $380,000. Speculative inland migration peaked during the pandemic. When urgency subsided, pricing normalized. Aerospace and industrial slowdowns added pressure. But Fresno's institutional anchors remain. California State University. Fresno sustains education and healthcare pipelines. Diverse small business ecosystems continue expanding. Traffic remains manageable. Land remains available. Family-scale housing under $400,000 still exists. Fresno is no longer a fallback. It is the reference point for middle-class recalibration in California. Bakersfield energy cycles and endurance. Bakersfield saw one of the steepest adjustments, roughly 20%, bringing median pricing near $350,000. Energy sector volatility hit wage stability. Overbuilding during optimistic cycles created excess inventory. Yet the fundamentals remain grounded in land ownership and practical living. Commutes to Los Angeles remain viable for certain professionals. Lot sizes are large. Property taxes are comparatively manageable. This is not a lifestyle market. It is a durability market. In cycles, durability outlasts glamour. Oxnard Insurance as the new gatekeeper. Oxnard has softened approximately 13% to around $650,000. The differentiator here is insurance. Wildfire and coastal risk premiums have doubled in some cases. Luxury buyers are recalculating carrying costs. Ocean views now come with actuarial math. Schools remain strong. Agriculture and ag tech sectors continue innovating. Commute access to Los Angeles is more manageable than Malibu. Negotiation has replaced trophy acquisition. Coastal property is no longer automatic appreciation. It is a capital allocation decision. Santa Clarita suburban ideal under review. Santa Clarita prices have declined about 11% to near $700,000. The city retains high-performing schools and studio-adjacent employment, but the commuter calculus has changed. When daily travel is optional, distance tolerance shrinks. HOA fees, freeway congestion, and value per square foot are under scrutiny. Buyers are negotiating credits. Sellers are adjusting expectations. The dream remains intact. The blind bidding is gone. Lancaster Space as Strategy Lancaster declined roughly 19% to around $400,000. Aerospace contraction slowed growth. Heat and distance test long-term residents. Yet acreage remains affordable. Solar infrastructure expands. Space and privacy remain unmatched at comparable price points. For buyers prioritizing autonomy over proximity, Lancaster is strategic. Victorville infrastructure and patience. Victorville prices are down roughly 17% to near $380,000. Remote buyers retreated, investors paused, but highway improvements and educational expansion continue. Housing stock, largely 2000s era construction, remains structurally modern. Victorville is not aspirational, it is practical. In uncertain cycles, practicality compounds. Riverside saturation, not collapse. Riverside has adjusted approximately 15% to near $550,000. Logistics, slowdowns, and overbuilding reduced scarcity. University of California. Riverside continues to anchor education and research employment. The issue is not desirability, it is inventory volume. When panic leaves the market, discipline enters. Riverside is transitioning from momentum to fundamentals. San Bernardino, from warning label to early bet. San Bernardino experienced the steepest correction, approximately 22% to around $450,000. Fire risk headlines and governance challenges eroded confidence. But beneath the surface, revitalization efforts are visible. Community investment is increasing. Median age is declining. The shift in buyer psychology is notable. Conversations center on inspection reports and renovation budgets, not existential fear. That change is foundational. The larger pattern, this is not a collapse of California. It is the end of automatic appreciation. For years, buyers operated under one assumption: pay whatever it takes, because the next buyer will pay more. That assumption is gone. Now the calculus is different. What is the insurance exposure? What is the long-term employment anchor? What is the water security outlook? What is the realistic rental yield? How long can I hold if appreciation stalls? These are adult questions, and markets reward adult behavior. The suburbs are no longer symbolic trophies. They are financial instruments tied to cash flow, durability, and livability. If you approach this cycle emotionally, you will hesitate. If you approach it analytically, you will see what most overlook. Leverage has rotated. Inspection contingencies matter again. Price reductions are common. Sellers are negotiable. Builders are offering credits. The window is not permanent. Markets stabilize. Capital returns. Narrative shifts. When it does, the disciplined buyers who moved during recalibration cycles are the ones who quietly control the board. California's housing dream did not vanish. It matured. And maturity, unlike hype, creates opportunity for those prepared to act with patience, precision, and restraint. The question is not whether prices fell. The question is whether you understand why and what that means for the next decade.